My greetings to everyone. I am Professor Namita Rajput, Professor in Department of Commerce, Sri Aurobindo College, University of Delhi. In the ongoing series of corporate governance, today we will be talking more on insider trading. As we have discussed about the initial part of the insider trading, in this part we will be talking on detection and prevention of the insider trading and some vital cases. Detection and prevention of the insider trading requires a combination of the regulatory oversight, internal control within the companies and the surveillance measures by the market participants. So, we will be talking first on the regulatory oversight. The regulatory authorities such as the Security Exchange Commission (SEC) in United States play a very crucial role in detecting and preventing the insider trading. They conduct the investigations, monitor the trading activity and ensure the security laws and regulations related to insider trading. The regulations often rely on tips, complaints and the referrals from the market participants to identify the potential cases of insider trading. We have just given an example of United States that is very important in this regard. The surveillance and the monitoring. The stock exchanges, the broking commission, the broking firms and other market participants, they use the sophisticated surveillance systems to monitor the trading activity for signs of insider trading. These systems analyze the trading patterns, volumes, price movements to identify the suspicious activity that may indicate the insider trading. There are some automatic alerts algorithms are often used to flag the potential suspicious transactions for the further investigation. Then there is an employee training and awareness. The companies can help prevent the insider trading across the globe by educating the employees about their legal obligations and the consequences of trading on material non-public information. The training programs can actually raise the awareness about insider trading laws and the regulations, the company policies and the importance of maintaining the confidentiality. The employees should be reminded regularly of their duties to comply with the insider trading policies and procedures. Next, we have a clearance procedure. Many companies require the insiders like the executive directors, employees to obtain a clearance before buying or selling the company's stock. The clearance procedure typically involve a pre-clearance of the trade by legal or compliance departments to ensure the compliance with the insider laws and the company's policies. Insiders may be required to provide a detailed information about their intended trades and certify that they are not in possession of the material non-public information. Restricted trading windows. The companies may implement restricted trading windows during which the insiders are prohibited from trading the company's stock. Restricted trading windows are often timed to coincide with the release of quarterly earning reports or other material corporate events to prevent the insiders from trading on undisclosed information. During the restricted periods, the insiders are actually generally prohibited from buying or selling the company's stock until after the information has been made public. The insider policies and the controls are actually pertinent in this regard, and we should have a very clear insider policies and control to place to prevent unauthorized trading based on material non-public information. Now, these policies should outline the company's expectation for compliance with the insider trading laws, procedure for obtaining the clearance for trades, restricted on trading during the blackout periods and consequences for violation of the policies. Then is your whistleblower programs. The companies and regulatory authorities often have a whistleblower program in place to discourage the individuals to report suspected instances of insider trading. The whistleblower program allowed the employees, investors and others to report the insider anonymously and may offer protection against the retaliation for the whistleblowers. Enforcements and penalties. Enforcement actions and penalties for the insider trading violations, they serve as the deterrents to the potential offenders. The regulatory authorities investigate the suspected cases of insider trading, which may impose fine, sanction, and actually disgorgement of profits and the criminal charges on the violators. The companies may also take disciplinary action against the employees who violate the insider trading policies. By implementing a robust compliance programs, educating the employees and actually actively monitoring the trade activities, the companies can regularly, the authorities can help detect and prevent the investor trading, thereby promoting the fairness, transparency and integrity in the financial markets. The ethics and morality, they play a very significant role in discussions surrounding the insider trading, as the practice raises the complex ethical questions about the fairness, transparency and the treatment of confidential information. So, here are some key ethical considerations which are related to insider trading. Let's talk it up one by one. The first and the foremost is ethics and morality in the insider trading, that is fairness and equal opportunity. Insider trading violates the principle of fairness by giving the insiders an unfair advantage over the other market participants who do not have the access to the material non-public information. It undermines the level playing field that is essential for fair and transparent markets, as it allows the insiders to profit at the expense of uninformed investors. The transparency and the market integrity. The insider trading undermines the transparency and market integrity by distorting the market prices and interfering with the efficient allocation of resources. When the insider trade based on the privileged information, it can lead to mispricing of the assets and erode the investor confidence in the fairness and integrity of the financial markets. Fiduciary duty and trust. The corporate insiders, they owe a fiduciary duty to their company and its shareholders to act in the best interest of the company and to avoid the conflict of interest. Next is your engaging in insider trading breaches this duty and erodes the trust between the insider companies and investors. The next important aspect as far as the ethics and morality in the insider trading is concerned is the property rights and the ownership. Insider trading raises the questions about the ownership of information and the rights of the individuals to profit from it. And also the critiques, they argue that the material non-public information, it belongs to the company and its shareholders collectively and should not be exploited for the personal gain by the insiders. Harm to others. The insider trading can actually harm other investors who rely on accurate and timely information to make the investment decisions. When the insider trade on the material non-public information, it can actually lead to losses for uninformed investors who buy or sell the securities at a distorted prices. Legal and regulatory compliance. The insider trading is illegal in most jurisdictions and violates the securities laws and regulations. Engaging in insider trading not only carries the legal and the financial consequences for individuals and the companies, but it also undermines the rule of law and legitimacy of the regulatory authorities. While some of them argue that the insider trading can actually contribute to market efficiency by incorporating a valuable information into the market prices more quickly, the ethical concerns associated with unfairness, lack of transparency and the breaches of the trust outweigh any potential benefits. Ultimately, promoting the ethical behavior and maintaining the integrity of the financial market requires a strict adherence to the insider trading laws and regulations, along with the commitment to fairness, transparency and accountability. Now, let us do some famous insider trading cases. There are several high profile insider trading cases. They have made the headlines over the years, involving the prominent individual companies and the significant financial transactions. So, let us see these cases. The first and the foremost case we are going to discuss is of Martha Stewart. In 2004, Martha Stewart, a celebrity, entrepreneur and a lifestyle guru, was convicted of obstruction of justice and lying to the federal investigators in connection with her sale of Imclone Systems stock. The Stewart stole her stock shares of Imclone shortly before the public notification announcement of the negative news that caused the stock prices to drop. She served a 5-month prison sentence and faced a financial penalty. Another is Raj Rangaratham. The Raj Rajaratham, the founder of Hegre Fund Gallon Group, was convicted in 2011 of multiple counts of insider trading. Rajaratnam was found guilty of obtaining and trading on material non-public information obtained from corporate insiders and the executives. His case was one of the largest insider prosecutions in history, involving numerous defendants and significant profits. The next case is of Ivan Boisky. Ivan Boisky was a prominent Wall Street trader who became an infamous person for his involvement in insider trading in 1980s. Boisky amassed a fortune through illegal insider trading activity, making the deals based on confidential information obtained from the corporate insiders. His activities eventually led to his arrest, conviction, and a significant financial statement and settlement with the Security Exchange Commission. Then we have a case of Michael Milken. Michael Milken, the former head of junk bond trading at Drexel Burnham, Labert, was indicted in 1989 on multiple counts of security frauds and insider trading. Milken was accused of engaging in various illegal activities, including the insider trading and stock manipulation as a part of his role in the high-yield bond market. Now he pledged the guilty to several charges and served time in prisons. Then we have a very famous case called Enron. The collapse of Enron in 2001 was accompanied by allegations of widespread accounting fraud and also the insider trading. The executives at the energy company were accused of manipulating the financial statements to conceal the losses and inflate the profits, while also engaging in insider trading to profit from inside knowledge of the company's true financial conditions. The Enron scandal led to a criminal prosecutions, civil lawsuits, and the regulatory reforms. SAC Capital Advisor, a hedge company founded by a billionaire investor Stephen A. Cohen, faced the allegation of insider trading and security fraud. There are several former SAC employees who were charged and convicted of insider trading offences, and the firm itself agreed to pay a record of $1.8 billion settlement to resolve the criminal and the civil charges related to insider trading. Now these cases, they illustrate a serious legal and financial consequences of the insider trading, as well as the efforts by the regulatory authorities to investigate and prosecute such offences to uphold the integrity of the financial markets. The insider trading remains a significant focus of enforcement efforts by regulatory agencies around the world, and the perpetrators continue to face stiff penalties for engaging in illegal trading activities. Now, what is the relationship of insider trading and the market efficiency? The relationship between the insider trading and the market efficiency is very complex and multifaceted. Some argue that insider trading can actually contribute to the market efficiency by incorporating a valuable information into the market prices more quickly. Others contend that insider trading undermisses the market efficiency by distorting the prices and creating an uneven playing field. Now, here is a very important closer look at how the insider trading intersects with the market efficiency. The first is your efficient market hypothesis, that is EMH. The efficient market hypothesis, it suggests that the financial market efficiently incorporates all available information into the asset prices, making it difficult for the investors to consistently outperform the market. According to this efficient market hypothesis, insider trading is expected to contribute to the market efficiency by allowing the prices to reflect material, non-public information in a timely manner. Next is your informational efficiency. The insider trading can enhance the informational efficiency by ensuring that the material non-public information is reflected in the market prices, thereby reducing the potential for mispricing and inefficiencies. And in theory, insiders who trade based on their superior knowledge, they help to disseminate the information more quickly and accurately throughout the market. The next is your price discovery. The insider trading can actually facilitate the price discovery by providing the additional information to the market participants about a true value of the assets. When the insiders, they buy or sell the securities based on their knowledge of a company's prospects, it can actually signal to other investors the likely direction of the future stock price movements, leading to more accurate pricing. Next is your market liquidity. Insider trading may enhance the market liquidity by increasing the trading volumes and providing the counterparties for other investors looking to buy or sell the securities. However, if the trading is perceived as unfair or unethical, it could deter the investors from participating in the market, potentially reducing the liquidity in the market. Next is your market integrity. There are some critics who argue that the insider trading, it undermines the market integrity by creating an uneven playing field where the insiders have an unfair advantage over the other market participants. When the insider trade based on the material non-public information, it can actually distort the prices and erode the investor confidence in the fairness and transparency of the markets. Next is your regulatory perspectives. From a regulatory perspective, insider trading is generally viewed as harmful to the market integrity and the investor confidence. The regulatory authorities enforce the laws and the regulations prohibiting the insider trading to maintain a level playing field and protect the investors from unfair trading practices. Overall, the insider trading may have some theoretical benefits in terms of incorporating the information into the market prices. Its ethical and the legal implication, they raise the concerns about its impact on the market fairness, transparency, and the integrity. There are some efforts to prevent and detect the insider trading which are very essential for maintaining the investor confidence and the efficient functioning of the financial markets. Let's see now a global perspective on the insider trading. The insider trading is a global phenomena that occurs in a financial market around the world, and the perspective on insider trading can vary across the different jurisdictions. So, here are some global perspectives on the insider trading. The first is your legal framework. The insider trading and laws and the regulations, they vary by country, with some jurisdictions having a stricter enforcements and the penalties than before. There are some countries which have the laws and prohibiting the investor trading, the specific definition requirement and the enforcement mechanisms can actually differ significantly. For example, the United States has a robust securities laws enforced by the agencies like Security Exchange Commission (SEC), while other countries may have a less stringent regulatory framework. The next is your cultural and the ethical norms. The cultural and the ethical norms can actually influence the attitude towards the insider trading in different countries. In some culture, insider trading may be viewed as a minor transgression or even acceptable behavior, especially in the situations where the personal relationship and the networks they play a significant role in the business dealings. However, in many of the Western countries, investor trading and insider trading is widely condemned as unethical and the illegal activities. Because of enforcement practices, the effectiveness of insider trading enforcement can actually vary widely across the jurisdictions. There are some countries who have well-resourced regulatory agencies with strong enforcement capabilities, while others may struggle to effectively police the insider trading due to the limited resources, corruption, or the lack of political will. International cooperation and coordination among the regulatory authorities can be very important for investigating and prosecuting the cross-border cases of insider trading. The market sophistication. The level of the market sophistication and the investor protection measures can also impact the perspectives on the insider trading. In the more developed financial markets with the robust regulatory oversight and investor protection mechanisms, these tends to be greater awareness of the trading insider trading risk and have a higher expectation of compliance with the security laws. In contrast, in emerging markets with less mature regulatory framework, insider trading may be more prevalent due to weaker enforcement and the oversight. The next global perspective on insider trading is about globalization and the technology. Globalization and advances in the technology have made it easier for the insider trading to occur across the border and in increasingly complex financial markets. The insider trading scandals involved multinational corporations and cross-border transactions highlight the challenges of regulating and enforcing the insider trading laws in a globalized economy. The international standards and the best practices. The efforts to promote international standards and the best practices for combating the insider trading have actually gained a momentum in the recent years. The organizations like International Organization of Security Commission IOSCO work to develop the principles and the guidelines for investor trading regulations and enforcements that can be adopted by the countries across the world. So, we can say that insider trading is a global issue that possesses the challenges for the regulators and the market participants, and there is a growing recognition of the need for coordinated action and the cooperation among the countries to address the insider trading effectively and uphold the integrity of the financial market worldwide. So, there are several trends and the challenges that are likely to shape the insider trading. So, let us dwell into that. So, yes, we are talking about now the future trends and the challenges in the insider trading enforcement. The first and the foremost is the globalization and cross-border transactions. As the financial market become increasingly interconnected, insider trading enforcement faces the challenges related to cross-border transactions and the jurisdictional issues also. The regulators will need to enhance the cooperation and information sharing mechanisms to effectively investigate and prosecute the insider trading cases that span the multiple jurisdictions. The technological advances. the rapid advancements in technology, including a high-frequency trading, algorithmic trading, and the digital communication channels, present both opportunities and the challenges for insider trading enforcement. The regulators will need to invest in sophisticated surveillance and monitoring tools to detect and investigate insider trading activities conducted through digital platforms and encrypted communication channels. Data analytics and artificial intelligence. The use of data analytics and AI holds a promise for enhancing the insider trading detection and enforcement capabilities. The regulators can leverage the AI algorithm to analyze the large volumes of trading data and identify the patterns or anomalies indicative of insider trading. However, the effectiveness of these tools will depend on the quality of the data and the ability to adapt to evolving trading strategies and techniques. The regulatory reforms and strengthening the laws. In response to the emerging risks and challenges, the regulators may pursue the regulatory reforms to strengthen the insider trading laws and efficient mechanisms. So, this could involve updating the existing regulations, introducing the new enforcement tools, and enhancing the penalty for the insider offences to serve as a deterrent. Then also about the whistleblowing protection and incentives. The whistleblowers can also play a crucial role in this regard, and we need to talk about their protection as far as the reporting of these inciting trade violations are concerned. Then we have a corporate compliance and internal controls. They have to be robust, strong in order to control such activities. Then we should also talk about the public awareness and the investor education. Increasing public awareness and investor education about the risk and consequences of insider trading can help deter unethical behavior and promote the compliance with the security laws. The regulators, industry associations and advocacy groups can collaborate together on educational initiatives to raise the awareness of the insider trading issues and empower the investor to make the informed decisions. So, we need to also work on emerging risk and complexities and develop the platforms in order to counter these threats to market integrity and the investor protection. So, in the end, we can say that insider trading enforcement will continue to evolve in response to technological, regulatory and the market regulations. Thank you so much.